Okay, number 14 is a bank reconciliation. Use the following information for a bank reconciliation for RST Corp. If a reconciliation is on the exam, the adjustments can be any kind of transactions we learned, not just the ones on this particular bank rec. Okay, so she put a little thing here, but yeah, I can copy that. All right, so we have our bank side, and our book side is what this is supposed to be. All right, so the bank statement shows the bank collected accounts receivable in a total amount 26.8. Let's skip that. Outstanding. Okay, let's go to this one. Bank statement shows the bank service charge. That's not what I want. The bank balance at December 31st, 2020 was 14.8. That's what I was looking for. So this is balance per bank. And it is 14,800. And the balance per books, the balance, that's the very last one, is 35,400. And remember, we have to make those two equal. I don't know why there's an extra line here. Oh, you know what? Because I can do like add. I can have additions. And then I'll have deductions at some point. We'll put that in a minute. Okay. Back to the top. The bank statement shows the bank collected accounts receivable in total amount of $26,800 for RST Corp. and deposited the cash in the account at the bank, but RST Corp has not yet entered the amount in the books. So that's going to be added to the book side. These are EFT collections of account receivable. I'm going to add that, 26,800. Outstanding checks total 12,500. Sorry, 12,500. That's a deduction. So let me put deduct. Outstanding checks. Minus 12,500. All right, then the bank shows the bank service charge is 1,800. So I'm going to come down here and do some deductions on the book side. That needs to come out of the books. All right, so this is going to be minus 1,800. The bank statement shows customers' non-sufficient funds check totals 35,900. Well, that's a pretty penny. So NSF checks. Remember, that means that somebody wrote us a check, we deposited it, and then it didn't clear their account. So to subtract that out, a deposit of 26,000 is in transit. So we're going to add that to the bank side. The bank balance, we have that already. The bank statement shows the bank deposited interest earned by RST in the amount of 3,800. So that's going to be added on the book side. All right, so we have them all. So let's do this. This is going to be just really the sum of these. And that's my adjusted cash balance. And then I'm going to just subtotal these out. I notice that already has the negative there. So I can actually copy this formula over to here. And they equal out, which they should. So yay. All right, now anything on the book side needs a journal entry. I'm going to come over here and do it. So journal entry for book adjustments. All right, so our first one was the EFT collections of account receivables. So we collected cash, and it came out of accounts receivable for $26,800. And then we earned some interest revenue. So that's a debit to cash and a credit to interest revenue. And remember, the actual final might be different accounts. Make sure you change them and you don't just copy these over. All right, then the bank service charge, that's a bank expense for $1,800 and a credit to cash. And then the NSF check goes back into account receivable and it comes out of cash. And that is it for that one. All right, let's see what number 15 is. Note payable. All right, on July 1st of 2020, ASDF Incorporated received $350,000 cash in exchange for a 6% long-term note payable. The note is payable over a 5-year term in $70,000 principal installments due on July 1st of each year, beginning July 1st of 2021. So a year later. At the time of each installment, the interest due at that time is paid also. In the space provided below, provide the following 3 journal entries. The July 1st, 2020 entry received the cash and put the note in the books. The December 31st journal entry, adjusting entry for 6 months of interest, and the July 1st payment of the installment and interest. Okay. All right. So first one up, July 1st of 2020. All right. We borrowed cash of $350,000 and we took out a note payable to do it. All right. December 31st, we need to accrue interest expense. So if you recall, that entry is interest expense and interest payable. All right, and then to calculate it, it's the $350,000 times the 6% interest times 6 over 12 months. All right, and then a year goes by, and it's now July 1st again of 2021. Okay, and we have to make our first payment. So we're going to debit note payable for the $70,000 principal payment. Right, that's what it was? Yes. The $70,000 principal payment. We're now paying this $10,500 that we accrued of interest. So interest payable comes off. We have interest expense for another $10,500 because it's been 6 months in the new year. And then cash comes out for the total. And that's it for number 15. All right, number 16. All right, on June 30th of 2020, QWERTY Corp issued bonds at face value in the total amount of $430,000. Bonds pay interest at a 4% interest rate. Bonds pay semi-annual interest payments on June 30th and December 31st of each year. Bonds mature in 5 years. In the space provided below, provide the following 3 journal entries. The June 30, 2020 entry for the issuance of the bonds, the December 31st, 2020 entry for the first interest payment, and the June 30th, 2025 payment to pay off the bond at maturity. Assume that the interest is already paid. Journalize only the bond payable payment. Okie dokie. All right, so June 30th, June 30th, 2020 is when I issue the bond. So I got cash, and it's going to be a credit to bond payable. And it was for $430,000. And then December 31st, I make my first interest payment. So that's interest expense and cash. And it's going to be the $430,000 times the 4% times 6/12. So 430 times 4% times 6/12. And then finally, all the years go by, and we've done that over and over every 6 months for 5 years. And now it's June 30th of 2025, and we're paying it off. So all that's left is to debit bond payable and credit cash for the $430,000. Okay, number 17. On November 26th, 2020, ZXCV issues 7,500 shares of common stock for $8 per share in cash. These common stock shares have a par value of $1 per share. In the space below, prepare the November 26, 2020 journal entry to record the issuance of common stock. Okay, let's go ahead and do that real quick. November 26th. We received some cash. We received 8 times 7,500 shares. Excuse me. And then we issue common stock, so we're going to credit common stock. But the most we can credit common stock for is the par value of $1. And the difference goes into paid in excess. You could also calculate it, and it would be 7 times 7,500. The 7 is the 8 that you received minus the dollar par. All right, on August 21st of 2021, Sweet Potato Corporation issues 4,000 shares of no par preferred stock in exchange for land with a market value of $125,000. I don't know how we went from this one to Sweet Potato, but anyway. All right, so what's the journal entry for that? In exchange for land, what day is this? August 21st of 2021. All right, they received land, and you record it at fair value, fair market value, $125,000, and they exchange preferred stock for it. And it has no par value, so the entire thing goes into preferred stock. All right, we have one more, but I think I'm going to make it its own video. It's inventory. So we're going to do Fifo and Lifo. So I'll do that by itself because it's going to be a little bit longer.